Hey guys, it's Dan here. In this week's video we will look at the difference between the stock market and the real economy. For this we will define the terms which are behind stock market and behind real economy. And then of course we will look at the US, especially in 2020, where we had a huge gap between a very good performance in the stock market and very bad pandemic related performance in the real economy. So we will look at the reasons behind it. And then we will try to understand and answer the question, is it dangerous if we have a gap, or is it normal if we have a gap between stock market and real economy? So let's get started, guys. Okay, so let's start with definitions first. On the left side here we have the stock market, and what is hiding behind the stock market? Well, usually it's always the default stock index. If we take the example of the United States here, it's going to be the S&P 500, which is the standard stock index. So what is the S&P 500? Well, it is an index summing up the 500 biggest listed US companies. If you are in Japan, for example, it's going to be the Nikkei, or in Germany, it's going to be the DAX, which is the 30 biggest companies in Germany. But to make it simple, actually, the stock market always reflected when we compare by the default stock index. Again, if we take the US, it's going to be the S&P 500. Now comparing what is behind when people say real economy, well, usually they talk about the GDP, which is gross domestic product. Again, gross domestic product, that's kind of a huge complicated topic, but to keep it very short and simple for this video, it's the sum of all goods and services which have been produced in one country for 1 year. To give you an example, for 2019, for example, the US gross domestic product was about 20 trillion US dollars for 1 year, for one country. The Japanese GDP was about 5 trillion. So we can say, when we compare the US to the Japanese one, that the 20 trillion US economy was about 4 times bigger than the Japanese one. Okay, now that we have looked at the definitions which are behind stock market and real economy, let's look at the reasons why we have such a gap between both of these terms. Let's start with the first reason, and the first reason is future versus past. Let me explain. You have stock market here, real economy here. What is behind the stock market value? What is behind the stock? What is the stock reflecting? Well, it is reflecting future expectations, future profits, future cash flows, future shareholder value. Okay, so when you invest in stocks, if you invest in the stock market, you are thinking ahead, and that's why the stock market had such a great performance this year in 2020, about 16% increase over the year compared to last year, the S&P 500, because people are expecting things to get better for the next couple of years, which is already priced in. Okay, to give you two examples. First of all, the vaccine effect. The vaccine has not been available in 2020, but with the good news which came up in December 2020, every investor is expecting that the crisis will be over with the vaccine, so it's already priced in, which of course increased the stock prices and the stock market as a whole, especially in the US. Another example is, look at what happened between Tesla and Toyota, for example. Tesla, brand new car manufacturer, Toyota, one of the biggest in the world. Look at the market capitalization. The market capitalization of Tesla is about 3 times higher than the one of Toyota. And this doesn't make sense if you look at the past performances, because Toyota makes about 20 times more cars than Tesla, right? So the idea is here to see, okay, Tesla has such a great advantage in electric cars and such a giant leap in technology. This is which is already priced in, so in the future expectations compared to Toyota, for example. On the other hand, we have real economy, which is, well, driven by or defined by GDP, gross domestic product, as I just said. And the idea here, as we just learned from the definition, is it's all about past performance. when we are talking about the gross domestic product of the US in 2020, it starts on January 1st, it ends on December 31st, okay? There is no future expectations or something, it's just what you have produced and sold in 1 year in 2020. So that's a huge gap, and that's why usually people say when you compare the stock market to the real economy, you are comparing basically apples to oranges. Well, I know this is not an orange, but I think you get the point. The second reason that explains the big gap between stock market and real economy, especially in the US, for example, is that when we talk about the stock market, we are not talking about everything, we are just talking about the default index. To give you an example with the US, as I just mentioned earlier in the definition, in the US we take the S&P 500 as the default stock index, and to remember you, it is the 500 biggest profitable listed US companies. Why doesn't it show you the full picture? Well, let me explain it like this. So when you read this definition, what do you see? First of all, the number 500, then you need to be profitable and you need to be listed. What does it mean? It means that this index here doesn't count every private company, of course. Here we are only talking about listed companies, so about public companies. It doesn't count the private companies, all the new upcoming tech superstar companies, for example. And it also doesn't track government spending, which is included in the real economy. And the second big factor you have to know at least is, as I just mentioned here, we're talking about profitable listed US companies, and which means actually it's pretty complicated to enter the S&P 500 because you have to be profitable for 4 quarters in a row. That's why it took so long, I think until December 2020, for Tesla to enter the S&P 500. To give you another example here, for example, Uber, which is a loss-making public company, is not included in the S&P 500, well, because it is not profitable for 4 quarters in a row. Now let's look at the third reason why we have such a gap between the stock market and the real economy, especially in 2020 and in the US, which is actually external factors. What do I mean by that? Central bank and politics. What do they have to do with the stock market? Well, let me explain you in a while here. First of all, as you know, in the US and in a lot of other countries, there has been huge stimulus packages that the government made to sustain the economy. In the US, for example, we had a $2 trillion stimulus package, and of course, part of that money went into the real economy, but most of it went into the S&P 500 in the stock market, has been reinvested because people were saving more, and this of course drove the S&P 500 up basically 16% over the year 2020, so a very, very strong performance. The first reason is related to the second one. The central bank has reduced the interest rates. Why? Because of course in a crisis you want to stimulate the economy, and for that usually you drop the interest rates so that people continue to shop around basically. What happened here is, as the interest rates, especially in the US, went basically to zero, a lot of people had a lot of money, especially investors. Money was really cheap, and what is happening when you put money somewhere and get zero on your savings accounts? Well, you have to find other ways to invest your money, and usually this always leads to higher stock prices because there is a lot of demand for stocks, and also higher demand for real estate because people buy their homes, for example, or big investors go into the real estate market. The last reason is also politics, bailouts. For example, when the government decides to save companies. The biggest example for 2020 would be airlines, for example. If you save an airline which was part of the S&P 500, for example, because it was profitable before, American Airlines, for example, then of course if you save this company, it's going to stay in the S&P 500 and investors will be happy and the price will go up, of course, because they know, they are saved. It's a bit the same story as 2008, 2009 with the banks, actually. question. Between the stock market and the real economy, there is a gap. Is this gap dangerous? Yes or no? Well, let's talk about it. First of all, you have to know, especially for the US, that the long-term stock market outperforms the economy. Let me explain. If you look at the 75 last years, so basically since World War II till 2020, you see that the S&P 500 increases by roughly 7% yearly, estimation roughly. If you compare this to the US real economy, so the US GDP, it was roughly 3% per year. So as you can see, over the last 75 years, clearly the stock market and the S&P 500 outperforms the GDP. So that's the first very important part. So to answer this question in, let's say, normal terms, if you want, it's normal that you have a gap between both because the stock market always outperforms the economy. But now let's look at 2020. Let's look at the data. For 2020, we see that we have a huge gap. The S&P 500, we already know the number, is up by 16% compared to 2019, which is absolutely huge, especially if you compare it to the US GDP. The US GDP of 2020, there are no official numbers right now. We are waiting for Q4, but it's roughly estimated from many investors that it's going to be roughly at -2. So roughly the economy, the US economy, is about to shrink by 2% compared to last year. So as you can see, if you compare the +16 versus the -2, you see that you have a huge gap this year. So what does it mean? Is it dangerous or no? I explained you all the reasons that led to this difference. I wanted to leave you with a last little thing to think about. It's called the Buffett indicator that a lot of people follow. Actually, he said that the best way to see if stock markets and stocks are overvalued or not is if you take the world stock market capitalization, so you take all the indexes from US, from China, from Japan and so on, you put them together, the market capitalizations of all these biggest companies, and you divide this by the world GDP, and he says that if this one here, if the stock market is more than 120% of the world GDP, that means that it is overvalued, that the stock market is overvalued. That's not a surprise, and especially when you look, I've seen a number before, it's like right now it's about 170%. So right now the stock market is super over-evaluated compared to the GDP, but which makes total sense. Because I mean, when you look at all the reasons and the pandemic which led to all this, it's very difficult to judge if it's already very dangerous, if there's gonna be like a backslash in 21, 22 or something. We don't know exactly, but at least, well, we don't know exactly. So let me know, what do you think? Is it already too dangerous? And are you selling your stocks, or do you have stocks? Do you sell them? Let me know. And I also wanted to tell you that I post once a week every Sunday. So if you like that kind of content, corporate finance, market finance, make sure to like, make sure to subscribe. It takes me about 6-7 hours to do with all the research and cutting and stuff like that. So make sure to like that stuff. See you soon. Enjoy your week. Bye bye, guys.